Here we go again. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the fresh haircut. I finally feel like I look like my actual age. I look a lot older. I throw on some glasses because I feel like my face is too round, so this just kind of helps me balance it out. But now every time I put them on, it's like, is that Andrei Jikh? Nope, it's Clark Kent.
I like your cut, G.
In today's video, I want to talk about the markets. So I'll show you my portfolio, I'll show you all of my stocks, all my real estate, and all my crypto, and tell you where we're at and where I think we're going, because the S&P 500 last week on Friday fell 2.2%, the Dow Jones fell 2.5%, and the crypto market fell substantially over 8% on news of the new Rona variant called Omicron. It's not a cryptocurrency, but it is an anagram of moronic. Also, it happens to be Twitter's new favorite meme that everyone's making fun of. This one's my personal favorite. China's like, Africa. How could you? But anyway, let's get serious for just a second, because the World Health Organization just labeled this as a highly transmissible virus, and they classified it as a level 2 variant of concern out of a possible of 3 levels. There's level 1, variant of interest, level 2, variant of concern, and level 3, variant of high consequence. Now, level 1 variant of interest happens every few weeks. Remember that beta variant we got earlier this year? That was level 1, variant of interest. We would pay close attention to that variant, and if things got worse and they progressed, it would have been upgraded to level 2, variant of concern, which is what this Omicron one is. Now, when that happens, it means a few things. Number 1, there's evidence of increase in transmissibility. This just means it's a lot easier to catch this thing and get sick. Number 2, because it's more of a severe disease, there's an increase in hospitalizations. Number 3, there's a significant reduction in the effectiveness of antibodies that was generated from a previous infection. Number 4, the effectiveness of treatment or vaccinations is a lot lower. And number 5, it's just harder to detect. All of those 5 factors classify something as a level 2 variant of concern. Unfortunately, there's not much information that we know about this thing until we sequence it and we learn more about it. So all of this uncertainty is creating a lot of fear and panic in the markets, which means that a lot of investors are selling off, and anytime that happens, the markets take a hit. So now let's take a closer look and see some of the future possibilities, and then I'll show you my investments and what's going on. The question on everyone's mind right now is, when should I buy in? When's the perfect time to buy the dip? It's really interesting because my girlfriend Corey keeps most of her money in cash. And every time I try to convince her to start investing, she'll tell me one of 2 things.
I'm just too afraid if I put my money in now, there's gonna be the everything bubble and I'm gonna lose my money.
She's not that dramatic, but you get the idea. She's afraid if she starts now, the bubble's gonna pop and she's gonna lose a lot of money. Or she'll say the opposite.
The market's just too hot, people made so much money in the last year, I just wanna wait until it cools off.
And it seems like this last year, it's been one or the other. So when is the right time to buy in? That's what I wanna talk about right now. So I wanna bring it back to the basics, because Professor Dumbledore once said, be greedy when others are fearful, and fearful when others are greedy. So let's take a look at fear. The best way to look at fear is through something called the VIX. The VIX takes a look at the 30-day options contracts, and it takes a look at the price and how much it deviates from the average in the last 30 days. Because the more these contracts are changing hands, the more volatility there is, and therefore the more that price deviates up and down, because investors have no idea what's gonna happen to the stock market in the short term, so they're trading it with each other in an attempt to speculate and make money with in the short term. I hope that makes sense. I know that's a lot of stuff to remember, so if you're ever confused or if you ever forget, just picture a hot potato. Sweet, hot potato. It's getting hot. Here, I don't want it. Here, you take it. Nice. I will hold this for as long as possible. Never mind. Nice. Now, a VIX of 12 or lower means that investors are as chill as cucumbers, everyone is perfectly happy, and the prices are stable. We know where the stock market's going. But if we get a VIX of 30 or more, that's when things are starting to get scary. Now, just for context, when the pandemic hit us in March of 2020, the VIX went up to 66 points. That was peak fear, peak volatility, everyone was terrified. As of Friday of last week, the VIX went up to 28.6 points, which tells us that investors are really starting to get scared. And remember, the VIX moves in the opposite direction of the stock market. So if the VIX goes up, the stock market goes down, and vice versa. Ultimately, what this all means is that investors are playing a game of hot potato right now. You get the idea. So now let's take a look at my personal stock portfolio and I'll show you what's going on. So let's start with the stock market. So as you can see, on November 15th, I was up $511,511, doing well, but as we got closer to the winter time, I'm now down to $489,000. Let me just show you my portfolio, because Remember, I have mostly blue chip dividend stocks. They don't grow a ton in value over time, but they don't lose a ton of value. They're steady and they continue to pay me dividends, and I'm perfectly happy with that. But take a look at all my stocks. They are down significantly, with Shell Oil, for example, down significantly more than my average. And the reason for this is because people are anticipating that if we have travel restrictions, then guess what? People travel less, there's less demand for oil, therefore there's an oversupply, which means that prices go down. So again, energy not doing so well. Now, as you go down, one stock stands tall above the rest, and that is PFE, which is PF Chang's. No, I'm just kidding, it's Pfizer. And it is up 6.11% in just a single day, which is, again, huge. It's still paying me dividends, I love that. But another stock that I own in the healthcare sector is a stock called Welltower, ticker symbol WELL. It's a healthcare REIT. And you'd think that if it's in the healthcare industry, it should do better than the rest, but it's actually doing a lot worse. And why is that? A possible reason is because 2/3 of their net operating income is coming from senior housing. And guess who would be most affected if the Rona decided to visit them? Older people. Now, this means that Welltower has to expand more resources to protect people and make sure that doesn't happen, but ultimately they don't have control over that, which means people are still gonna get sick anyway, and that will affect their occupancy rates. And because investors know that, which means that maybe investors sell off a little bit more because they view it as a little bit more risky. Now, another one that's true as well for this is Ventus, same exact story, and again, people are just scared that this could be a lot worse than maybe it actually is. So there you go, not all stocks in the healthcare sector are going to do well in a possible pandemic. If you're going to gamble, just be very careful. You're not guaranteed to make money unless you know exactly what you're doing, which apparently I don't. There's also stocks like Eat, which is a Brinker International, and they own brands like Chili's and Maggiano's, and they're down. Why? Because people are afraid that if we go into a possible lockdown mode, or maybe restaurants get restricted, then that's gonna hurt their bottom line. They're gonna make less money. A lot of them are gonna go out of business. So again, investors sell off. Anyway, all of my stocks are down substantially, but stocks that have done well are stocks like Moderna, which is up 20.5% in a single day. That's insane. But it's interesting because Morningstar is giving them a rating of 1 out of 5 stars, which means their fair value estimate is something like $159 in comparison to what the stock is currently trading at, which is $336. Now, take a look at this. Let's zoom out 1 week and boom. That is just insane. Like, that is not a sustainable growth, obviously. But again, who knows how high this will go if this pandemic gets worse. But in the long run, I just don't see this kind of valuation staying this high. I think that values would revert back to the average. So I would just not speculate and gamble on healthcare unless, again, you know exactly what you're doing. In the meantime, though, I'm just buying $1,000 a day into VTI, and that gets me by just fine. So that's the stock market. Now let's talk about real estate. I think we're in a real estate pandemic, but not the kind that people think about or people want when they talk about buying the dip. According to CoreLogic, home price growth will slow down substantially in 2022. And that means the exact opposite is probably gonna happen, because even Zillow, who had so much data in 2020, got it wrong when they told us that prices would fall. Instead, they exploded. In August of last year to August this year, prices grew by 20%. So that tells me no one has any idea what's gonna happen to real estate, but it depends on the supply of inventory and the interest rates. And even if we increase the interest rates, which maybe we might, prices won't correct as much as people think. Remember, for every 1% increase to the interest rate, the price will correct by about 10%. That's the correlation. 10% for every 1%. And there's just no way that we're gonna increase the interest rate by a full 1%. If anything, we might go from 3% to 3.25, maybe 3.5% next year, which would give us closer to a 5% correction at the most. Instead, the expectation is that homes will still grow by around 3.6% next year, which is not as much as 2020, but it's still going up rather than down. And remember, the demand is still high. Institutions and hedge funds, they'd buy the dip. Millennials are starting families, they want to buy the dip. We also have interest rates reasonably low, even at 3.5%. So if you're somebody who's shopping for a house right now, I would try to find a good deal now rather than wait for a crash to happen, because based on what we know so far, that's probably not gonna happen anytime soon. But that's real estate. Now let's talk about everyone's favorite asset in the whole wide world, Pokemon cards. No, I'm just kidding. Crypto. Still not a crypto channel though. Bitcoin and crypto are also down over 8% as of last Friday. I made an entire video explaining why this happens, but in a nutshell, it's because Bitcoin and crypto live in a very fast-paced market. And anytime there's a little bit of negative news, like the rejection of a spot ETF or maybe a new variant on the horizon, that's when the price falls. And whenever the price falls, that triggers a new wave of liquidations, which means people are forced to sell off their leveraged positions, which triggers the price to go down, which triggers a new wave of sell-offs, and so on and so forth. It's a self-fulfilling prophecy. Now, for me though, that 8% drop is not enough to justify buying in a bunch all at once. I want to see way more fear in the markets. I want to see blood in the streets. Not literally. I want people to be more scared before I go shopping. I want crypto to be down between 30 to 50% from the all-time highs before I put in a ton more money. But in the meantime, I just continue to dollar cost average at $1,000 a day, just like my stock portfolio. Lucky for us though, there are so many catalysts for why crypto will go up next year. Here are just some of them. Number one, we have the recent Taproot upgrade, which brought smart contracts to Bitcoin, and hopefully next year, there'll be some really interesting projects on Bitcoin. Number two, more regulatory clarity, which means people feel more safe about putting their money into crypto. Always a good thing. Number three, we might get the spot ETF for Bitcoin, which means trillions of dollars pouring into the crypto space. Number four, we have Elon Musk hopefully accepting Bitcoin again for Tesla, which I know some people are like, who cares about Elon or Tesla? But the truth is a lot of people do, and they follow what Tesla does. And if he starts accepting it again, once it becomes more energy compliant, well, guess what? The price will go up. And the last thing, of course, is the stock to flow model, which regardless if you believe it or not, has been really helpful in showing us what Bitcoin's price should be at any given moment. And hopefully next year, more people are exposed to crypto and finally they'll start to invest as well. So now let's just wrap everything up and make sense of it. I'll tell you what I think, and then I'll tell you the counter argument to how I could be wrong, because I probably am. I think the price of assets will be worth more tomorrow than they are today. We'll see these level 1 variants that we're not gonna find interesting at all because they're gonna be so common. Some of them though will evolve to level 2, variants of concern, like Omicron. Right now that sounds scary, but over time we're gonna get better at handling the situation because the time to sequence the genome of the virus will shorten. The time to get the vaccine will shorten. All of this means the markets will eventually become desensitized to this information and they'll just shrug it off. If you combine that with supply chain issues in the next 6 months to 8 months to even a year, like some people are saying, and you get a high demand and a low supply situation, which should put prices through the roof again. If the Federal Reserve steps in and increases the interest rates, I still don't think that that will affect the markets as much as people think. Check this out. Historically speaking, the first 3 months following an increase to the interest rates, the stock market, or the S&P 500, falls by about 2%. But following the next 12 months after that, the stock market returns about 7%. So even though we could increase the interest rates to try to cool the economy down, that fall will still be very small and temporary because eventually everything goes back up again. So now let me share with you the counter argument from Cathie Wood. Cathie Wood says that we'll have deflation, and she gives 3 very solid reasons why she thinks this will happen. And the first reason is AI. Artificial intelligence training costs are down 68% every year. This, she says, is going to create a huge amount of demand for AI. And remember, AI creates automation, which means we need less people to do things with, which means deflation. The second reason is something called creative destruction. And the best way to understand this is to think about Amazon and how it destroyed America's shopping malls. Think about Netflix and other streaming platforms which destroyed Blu-rays and DVDs. Think about tablets and iPads that destroyed magazines and books. Anytime we create a product that disrupts an industry, we set off an arms race to create the best version of that thing. The way this ties to deflation, though, is that this innovation in technology creates products that ultimately save us on time and money. And anytime you have people and companies using products that save them time and money, that means they need less resources and less people to do those same things with, which creates deflation. And the third thing she says will contribute to deflation is cyclical inflation or cyclical deflation. This is referring to materials reverting back to the normal. Even after they spiked to $1,700 in May like lumber did, it still went back to $791 today. And all materials across time will hopefully go back down to the average. And those are the three reasons she thinks will contribute to a deflationary economy rather than an inflationary one. And I actually happen to agree with Kathy on this one. If all of this is overwhelming and you don't want to time the market, then just do what I do and dollar cost average and you'll be a winner. As always, don't forget to have a wonderful day. Smash that like button, subscribe if you haven't already. Go get up to $250 worth of free Bitcoin with this BlockFi link right here, blockfi.com/Andre. Go get your 2 free stocks with Webull. Links down below, and when you do, go track them automatically with spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon, take care.